So Heather, I want to dig on this collateral lender versus cash flow lender distinction because in my experience, I'm, by the way, a veteran of 4 SBA loans and love the program and built my company on the back of SBA loans. So love the program. Have borrowed from a bunch of banks and have not had the pleasure of borrowing from Live Oak, although I regret that because I've heard nothing but great things. My experience has been that many, and I don't want to say every, but almost every bank will tell you they are a cash flow lender and then dig in super hard on the collateral. So how can you tell the difference between a bank that tells you they're a cash flow lender and is actually just relying on the SBA backstop to get them there in collateral versus a lender who is actually full of it and just cares about your business assets?
I think that is a great question because I'm going to answer it a couple of different ways. First of all, the practice of just kind of reeling you in with telling you what you want to hear is unfortunately very common in the SBA industry because almost all SBA lenders are on commission. They're commission salespeople. They're competing even internally with each other for the SBA, numbers that they're supposed to produce. And a lot of them, unfortunately, have a tendency to tell you what you want to hear, get it in the pipeline, and then let credit tell you the bad news,
That happens a lot.
A lot. And I will say this as a little plug for Live Oak. Live Oak is different because we are the number one. We're the only bank in the business that doesn't pay anybody commission. That's not how anybody's compensated in the bank. We're compensated well, but we are not on commission, and it does affect behavior. We don't want to waste our time. We don't want to waste your time. So that's important. You kind of have to feel that out. Is this a salesperson that just wants to get me into the pipeline, or are they telling me the truth, the hard truth? So how do you tell? Well, if I don't want to waste your time or mine, I'm going to ask you a lot of questions before I say yes, right? I'm going to do a lot of vetting of that deal with you to make sure it's going to fit my credit guidelines. If I'm a cash flow lender, I need all that information because if we're underwriting cash flow, we need to know everything about that business. We need to know, about concentrations. We need to know a lot to be comfortable without collateral. If I go kind of light touch, that's a kind of a sign that I may be just a collateral lender. I'm looking for do I make the debt coverage work? And then let's start talking about collateral. And that's kind of how a collateral lender will tend to underwrite, real light touch on the business and then a deeper dive on the collateral and they're comfortable. So I think that's maybe the best way to tell.
While we're on the topic of collateral, should we talk about kind of what's going to happen to your personal collateral when you take an SBA loan as a borrower, so people can kind of understand what's market, what do banks have to do, what do some banks do they don't have to do, what should you expect from a collateral perspective? How do banks, even though you're a cash flow lender, you're going to think about collateral and you're going to try to perfect your collateral, and the SBA requires you to do some things. So can you share with people what's going to happen on the collateral side, even when using a cash flow lender?
Absolutely. So the SBA has some black and white rules around collateral. So even for a cash flow lender like us, where we don't care if you have the collateral, we still have to follow those rules. So every bank will have to follow the same rules that I'm going to say right now. So that is anyone with 20% or greater economic benefit from the business, that's ownership or other type of economic benefit, must provide a personal guarantee. It's a full personal guarantee. It's not limited. Even if there are multiple partners, everyone's providing a full personal guarantee. Doesn't have a burn off or anything like that. And for each of those personal guarantors, we're required to look at your personal financial statement to see if there's any real estate that has at least 25% or more equity. Now, this has got to be real estate that you own yourself or you own with a spouse. If you're in a partnership on, some other, investment property, we can't use that. But usually it's your house.